Ever stared at a stock chart and felt lost? You're not alone. Most beginners see price movements as random, but there's a hidden language in those charts: candlesticks. Candlesticks reveal the real-time battle between buyers and sellers, giving you insight into market psychology. Think of them as the highlights reel of a cricket match. Not just the score, but every key play. Unlike simple line charts, candlesticks show where the price started, ended, and the extremes it reached. This detail helps you spot greed, fear, and indecision in the market. Relying on news or tips is risky. By the time you hear it, the move is over. Candlesticks let you see price action as it happens, so you can make decisions based on real data. They're your map to navigate the market, showing you not just the main roads, but every shortcut and traffic jam. Learning to read candlesticks is your first step to trading independence. With this skill, you'll stop guessing and start understanding what's really happening. In this video, we'll break down how to read candlesticks step by step. By the end, you'll be able to spot opportunities and avoid traps like a pro. Let's get started. So, what is a candlestick? It's a simple shape that packs a ton of information. Each candlestick represents a set time period, could be a minute, an hour, or a day. It tells you 4 things: where the price opened, the highest and lowest points, and where it closed. The thick part is the body. If it's green, the price closed higher than it opened, bullish. If it's red, it closed lower, bearish. The longer the body, the stronger the buying or selling pressure. The thin lines above and below are wicks. They show the highest and lowest prices reached. Long wicks mean the price tried to move further but was pushed back. For example, a green candle with a long upper wick means buyers pushed the price up, but sellers forced it back down before close. A red candle with a long lower wick means sellers drove the price down, but buyers fought back. In one glance, you see the entire story of that session's trading battle. Candlesticks make it easy to spot who's in control, buyers or sellers. Once you understand these basics, you can start spotting patterns that predict what might happen next. It's like reading the market's mood in real time. Mastering this is the foundation of smart trading. Let's look at some powerful patterns. Now let's dive into single candlestick patterns that can signal big market moves. The hammer. A small body at the top with a long lower wick, usually after a downtrend. It means sellers pushed the price down, but buyers fought back. Potential bullish reversal. The shooting star. Small body at the bottom, long upper wick after an uptrend. Buyers tried to push higher, but sellers took over. Potential bearish reversal. The doji, almost no body, looks like a plus sign. It means indecision. Neither buyers nor sellers won. After a strong trend, it can warn of a possible reversal. Context is key. A hammer is powerful after a drop, not in a sideways market. A shooting star matters most at the top of a rally. These patterns are signals, not guarantees. The hammer says buyers are waking up. The shooting star warns sellers are gaining control. The doji says the market is uncertain. Listen to these signals, but always check the bigger picture. Don't trade every pattern. Wait for the right moment. These single candle clues are your first step to reading market sentiment. Spot them, understand the story, and you'll be ahead of most traders. Next, let's see what happens when 2 candles team up. That's where the story gets even clearer. 2 candle patterns reveal even stronger shifts in market control. The engulfing pattern. After a downtrend, a small red candle followed by a large green one that completely covers it. Bullish reversal. The opposite, a green candle engulfed by a big red one after an uptrend, signals a bearish reversal. These patterns show one side overpowering the other in dramatic fashion. The harami, a large candle followed by a small one inside its body. In a downtrend, a red candle followed by a small green one signals selling is losing steam. Potential reversal. In an uptrend, a green candle followed by a small red one means buyers are tiring. Engulfing patterns are loud signals. Harami patterns are subtle hints. Always look for these at the end of trends, not in the middle of sideways moves. 2 candle patterns are like a conversation between buyers and sellers. Watch who's winning. Use them to spot when the market might be about to change direction. But remember, confirmation is key. Don't jump in on patterns alone. Look for supporting evidence. Next, let's see how 3 candles can make the message even stronger. 3 candle patterns are the market's loudest announcements. The morning star. After a downtrend, a long red candle, then a small candle, then a strong green candle. This signals a powerful bullish reversal. The evening star. After an uptrend, a long green candle, then a small candle, then a strong red candle. Bearish reversal. 3 white soldiers. 3 long green candles in a row, each closing higher. Strong uptrend starting. 3 black crows. 3 long red candles in a row. each closing lower. Strong downtrend beginning. These patterns show a clear confirmed shift in momentum. They're more reliable than single or double patterns because they show a sustained move. Look for them at the end of trends for the best signals. When you spot a triple candle pattern, pay attention. It's the market making a big statement, but as always, check for confirmation before acting. Let's talk about how to do that next. Spotting candlestick patterns is great, but confirmation is what makes them powerful. Never trade on a pattern alone. Always look for supporting clues. The best confirmation: support and resistance levels. If a bullish pattern forms at a strong support or a bearish one at resistance, the signal is much stronger. Technical indicators like moving averages or RSI can add extra confidence. For example, a morning star at support with RSI rising is a high probability setup. Always check where the pattern forms. Location matters. Patterns in the middle of nowhere are weak. Patterns at key levels are gold. Combine candlesticks with other tools for smarter, safer trades. This is how pros stack the odds in their favor. Don't rush. Wait for all the pieces to line up. Confirmation turns a good pattern into a great trade. Now, let's wrap up with some practical tips. You've learned the basics now. Here's how to use candlesticks like a pro. Always consider the bigger picture. Is the market trending or moving sideways? Only trade patterns that align with the overall trend and appear at key support or resistance. Be patient. Don't jump at every pattern. Wait for the A-plus setups. Overtrading is a fast way to lose money. Quality beats quantity. Always wait for the candle to close before acting. A pattern isn't real until the session ends. Practice is key. Go back on charts, spot patterns, and see what happened next. Learn from both wins and losses to sharpen your skills. The more you practice, the faster you'll spot real opportunities. Don't rely on tips or news. Trust what the chart is telling you. With discipline and patience, candlesticks can become your edge in the market. Keep learning, keep practicing, and you'll trade with confidence. Good luck and happy trading.